Have you ever wondered about the different markets that make up the fascinating world of stocks? Today we will deep dive into the primary and the secondary markets, demystifying how they work and why they matter to you as an investor. You may have heard of it before that the stock market has different markets. Well, the stock market comprises of two types, primary and the secondary markets. In the primary market, companies list their shares through an initial public offering or the IPO to raise capital. Transactions occur between the company and the retail investors. The secondary market involves transactions between common individuals. Instruments in the stock market include shares or stocks, bonds, fixed income instruments, and derivatives. Understanding the primary and secondary markets is essential for comprehending how securities trade. But wait, that's not all. We'll also explore the intriguing world of derivatives. Derivatives are financial arrangements or products. These derive their value from an underlying asset. Underlying asset can be a commodity, currency, or a security. These include futures, options, and warrants. For example, instead of trading silver, one can trade a derivative that represents the value of silver. Derivatives offer easier management and handling compared to trading the actual asset. Physical settlement is also an option for derivatives. By the way, if you are new to this channel, then consider subscribing. In India, there are two major stock exchanges. They are the BSE, Bombay Stock Exchange, and NSE, National Stock Exchange. Both exchanges have a large number of listed stocks and ease of buying and selling of shares. Brokers like Zerodha, Crow, etc. act as intermediaries between buyers, sellers, and exchanges. They might charge trading fees, depending on the broker. They do not hold shares. Stocks will be in the investor's demat account. They will ensure their safety even if the broker shuts down. SEBI, or the Securities and Exchange Board of India, serves as the market regulator, monitoring activities, especially after the Harshad Mehta scam. There are tools like ticker tape where you can see if there is any red flag for individual stocks. Investing in equity is quite risky and you have higher chances of losing invested money. If you are new to equity, then I would recommend you to check out this video on different kinds of funds that are available. Thanks for watching and consider subscribing.